Hello, everybody. Thank you for joining me again. Now, at Move IQ, we get lots and lots of questions about the mortgage market and what's going on, particularly from first-time buyers. Obviously, the mortgage market is a kind of moving beast. It is always changing as lenders react to conditions at the time. So today, I'm really, really pleased to be joined by Paul Archer, who is a senior product manager at the Nationwide, one of the country's biggest lenders. So I'm super pleased and super grateful for him giving up some time and letting us know what is going on in the mortgage market. Paul, if I can start really broadly with that, what is going on? Is it possible to get a mortgage at the moment?
Oh yeah, absolutely, Phil. Hello to everybody watching now. Yes, 2020 has obviously been quite an unprecedented year for many reasons, and everyone sort of knows the reasons why. What we were quite heartened to see through 2020 was the mortgage market and the housing market be particularly buoyant. After a particularly slow start, as you'd expect from the first lockdown from March and April time. A record low for a month of housing approvals in May, to then have a 13-year high in housing approvals over 2020 as a whole was testament to the strength of the market, really. And
It kept you guys very busy, didn't it?
Yeah, absolutely. I mean, a lot of, to be honest, a lot of our plans were made around the market being soft, and demand being soft, and builders having to react to the coronavirus, and valuers and all the entire chain that are reliant or play part of that chain having to react as well. So
it must have been phenomenally difficult for you as a lender in that time, because could the surveyors get into the houses? Where would the values sit? Because you wouldn't have up-to-date comparable evidence. That must have been extraordinarily difficult for you, for the surveyors, for the underwriters, for everybody involved. Added to which, of course, I guess lots of people were working from home.
Absolutely. So that it was a huge strain on the whole market. It saw a lot of innovation as well, though. I mean, lenders were very, very quick in the UK to move to a position where we could support the market. We moved very quickly to have operational colleagues from home be able to issue the offers and support the lending that was going through. Moved very quickly for our assessment of properties to go online and use more of the desktop technology. Use what the internet is brilliant at, and that's just given us a lot of information very quickly at our fingertips. And once we mobilise that, I think that was sort of our part of the bargain, really, in terms of being able to support the demand as and when it came through.
Yeah. And where are things at now? Because, as you say, we had a booming market last year. Yet to see how things are going to pan out this year. I mean, it's against everybody's surprise, given that sentiment is usually the driver of a housing market, and you would have thought in the middle of a pandemic, sentiment would have been pretty low, but actually it seems to have been really high, and so far continuing.
Yeah, I mean, we're not blind to those factors that are obviously playing a part in the market and the strength of the market at the moment. There's been unprecedented support of the labour market through the furlough scheme. There's been unprecedented support of the actual housing market through stamp duty holidays, which is going to end in a few weeks' time. Add to that the sort of the socio-economic factors. We've seen that it actually, our view of the market was at the start that people wanted to move out of highly urban areas into suburban or even rural areas. Now, when we've looked at that a little bit more in depth, it seems that people aren't really leaving their area, but they are moving towards houses that are slightly bigger, slightly more space, gardens. So we are seeing that trend, but how long that continues and whether we see a rebalancing of that as the economy rebalances back towards a more city-based economy, we may see a slight reversal of that trend. But I think we've probably crossed the bridge, and we're not going to go back over in terms of the preponderance of working from home, flexible working. That all points to those trends continue.
It's going to be really interesting, sort of next 12, if not 18 months, isn't it? Because we've got all those support measures concluding. And what's going to happen to the economy as they conclude? We don't know yet, because we don't know the damage, because it's been well hidden and the temporary measures have absolutely done their job. But as a lender, I guess you are very much mindful of the wider economy, and who you're lending to, and how much you're lending, and on what you're lending. How is the kind of assessment of all of that
Yeah, I
changed,
mean,
or likely to change?
so in the pandemic, during the first lockdown and through to now, um, we've seen some tightening of criteria across the market, and that largely a prudential step. I mean, seen obviously there are some industries that are greater hit than others. It's very difficult to make judgment calls
Mm,
on individual cases like that. Some people have absolutely thrived, and some people have struggled in same industries. I think as we move through, it's we're still not at a place as a market where we are fully back on board with variable incomes. I think that's the main sticking point. Um, People who are heavily reliant on annual, quarterly bonuses, commissions. It's a very difficult place to be in at the moment. But for those in stable work, um, who have continued in that vein over lockdown, then the mortgage market is open and ready to lend.
okay.
So the 90% LTV market, for example,
Yeah.
was one of the ones that was shut during the first lockdown, has gradually returned. Nationwide, we were one of the first lenders to go back into that market,
Okay.
and by December, pretty much every high street lender was in that market, willing to lend to what is traditionally a first time buyer market.
Okay. So if somebody's had steady income through the last 12 months, they should be fine. Um, are you at the same time looking at who they're, I guess, are you not just looking at the employee? Are you looking at the employer, and what you make of where they work, and how they might have been affected, given that we've had all of the wonderful support from the government?
Yeah, I mean, we obviously supported the payment holiday scheme quite robustly when that came in, to make sure that people who were not only definitely affected, but those who thought they might be affected, and then
Yeah.
obviously that was for our existing customers. I mean, we wouldn't say no to a lot of a lot of those people. It would need to be a very robust discussion around what they could afford, and as a result, they may see that what they want to borrow being
Mm,
capped
mm.
below potentially what they want. That's not to say we wouldn't lend to them. It's just the case they may need to uh, moderate their expectations. I think
Yes.
that's a prudent stance
Yeah.
that I think it benefits everyone. I mean,
Yeah.
no
Yes.
one in the industry wants to get to a place where the industry is lending to
Mm.
people who can't pay back for whatever reason.
I,
um,
I,
and
I, I
that's where we're
want
at the moment.
I absolutely agree with you, and but there is a, I'd like to talk about that in a little bit. But so when you say they need to assess or amend their expectations, so you will lend, but you're talking about the terms on which you'll lend, whether they'll need to have a bigger deposit, or they'll need to have have a higher interest rate. How about length of mortgage? Is that something that you're looking at?
Yes, it's one thing we've had, Nationwide has done in the last month, is extend our maximum terms for 90%
Okay.
LTV mortgages out to 40 years. Again, we took that as a prudential step. That obviously, if you take your lending over a longer term and you're paying the debt back slower,
Yeah.
that means essentially that you any correction in the housing market you may get caught up with. And again, we're just really mindful about people falling into potentially negative equity. Now, we're not suggesting that the housing market is going to fall that far and house prices might correct that much, but
Yeah.
equally, it's a potential scenario that
Yeah.
by the time you look at the whole market, may not happen. When you look at individual lending in individual areas, it's a possibility. So
Yeah.
we
Yeah.
need to be very careful there. We are, and it took us a while to be comfortable with that, and we feel we're more comfortable with it
Okay.
now.
Okay. And has the 40-year mortgage, has that been a popular product?
Yes, it has been. I think again, people, I think the good thing about the tightening of criteria is that people are now really assessing what is in their best interests rather than just taking
Yeah,
the longest term to keep payments low
got it.
through that
Yeah,
initial period.
yeah.
It has been popular, and because ultimately it increases the amount people can borrow,
Mm,
and that's great for someone who potentially wants to
mm,
stretch themselves a bit, as many first time buyers do.
yeah,
But equally now, I think we've gone through a bit of a change where people are really asking themselves and getting the numbers together around, can I afford this on a 25-year term or a
yeah,
slightly shorter term, pay the debt back, not pay for the
yeah,
eyes open.
yeah. Um, so you've had to tighten the criteria to protect yourselves as well as your lenders, your customers. Do you see that criteria remaining tight, or do you feel, as you understand more about, as we come out of this goings on and you understand more about the market, etc., and just the world begins to settle down, do you think the criteria will ease? I mean, you're in business to lend money. You want to lend money where you can, but you obviously need to do in a safe and correct way.
Yeah, I mean, more so for us as a building society, being there to serve our members. Absolutely. I mean, just to be clear, I think the vast majority of criteria are back to pre-pandemic levels.
Okay,
Um,
that's
there's not
good.
there's not a really obvious tightening of criteria that's left, apart from 95% LTV mortgages are
Yeah,
few and far between, um, because of the risk to house prices, and um, variable income uh, variable incomes, people with reliant on bonus and overtime and commission,
yeah,
are not fully back to the sort of the levels that they were being lent to. Having said that, that's the market is continually evolving, and I
yeah,
think we always take into account what people need and want within a framework that makes sure that everyone's safe within that lending.
yeah,
And if we do get back to a space where employment is starting to rise again and sustainably rise, um, and we're confident about the housing market, then I think as an industry that those things will return and potentially expand.
okay, good, good. On the topic of the 95% mortgage, Paul, can I ask your thoughts on so Boris Johnson has sort of floated the idea of a state-backed 95% mortgage to try and help particularly first-time buyers break into the market. Um, any thoughts from you on that one? I mean, it just seems a
Yes.
little bit strange to me if you, as the Nationwide, were nervous about lending 95% mortgages, and you're in the business of assessing risk and value, etc., and you've had to do that because you've had to follow government procedure because of what happened in the subprime debacle in 2008. It seemed a little bit strange to me that the government and us as taxpayers would take on the risk merrily and do 95% mortgages. I don't know. Am I speaking out of turn? What's your thought?
No, I mean, we have, say, supported government schemes strongly at Nationwide. The Help to Buy scheme is one that we lend on, and we've been big supporters of over the last 7 years now. In terms of 95% LTV lending, I think we think that the best solution would be for the market to come up with its own solution.
Yeah,
Um, you know, Accept that some other lenders, that will be too risky for them, and you need a swell of opinion really amongst lenders, because the first one back into that market essentially puts the head above the parapet, and essentially ends up taking the majority of the risk. Um,
yes,
so accept, that's obviously quite a utopian position that we would love the market to return with, if we chose to go back, that everyone goes back at a
yeah,
similar time. That notwithstanding, and maybe that's not realistic at the moment. So yes, we would be supportive in theory, that it's an important market for first time buyers. We know that it's one of the biggest problems that first time buyers face is having to pull together, at least £10,000 really
mm,
for a deposit.
mm,
When the cost of living is high, we know rents are high. Um, it's
yeah,
it's a it's a big issue. I think we could be careful. I think we should be really sort of cognizant of what we wish for, and how that risk gets passed on and to whom. Obviously, there'll be some form of risk transfer in those products in terms of where the costs go, and whether it ends up with the end customer or whether it ends up with the government or the lender. I think we need just more information, really. But the end goal is just, and one we definitely support.
Okay, thank you. Any thoughts on prospects for interest rates? I mean, none of us have got a crystal ball, but the feeling for me is that, well, they can't go down. Any guidance on that? I'm not going to hold you to it or anything, Paul, but
yeah. I mean, for customers with a lot of equity, rates are as low as they've ever been, and we expect competition in the market to be fierce, to continue to be fierce. We know there are some lenders in the market who are rich in terms of having a lot of money to lend, and the way they're going to make money back is to lend that money. So there is definite scope for competition to drive rates down. How far they go, I think, would be a more of a crystal ball question. Swap rates are as low as they've been. You're really dependent then on the economic outlook and where the trajectory of bank base rate from here, and any potential negative move. So we'd be tied to that, I think. But that notwithstanding, that it's been a pretty good time for mortgage borrowers. The rates are very cheap, and competition is keeping them low.
Do you ever feel, just to finish off with, do you ever feel kind of caught in the middle a bit? Because the lenders and seem to get an awful lot of bad press. That they won't lend this and they won't do that, and you've got to have a big deposit and it's unrealistic. But then on the other side, you want to lend money, but you need to assess levels of risk in order to do that, and so you're also protecting people. You're kind of trapped in the middle a bit, aren't you?
Absolutely. We always try. The way I characterize this when I talk to people about my job is that we're always trying to balance three things that it's impossible to balance. You're trying to lend the money you have to lend. You're trying to lend that at a margin, which means that the business is sustainable, and you can return. For us, it means you can return value to the members through slightly lower rates or slightly better savings rates, or however. And then within that, you've got to manage your risk. And obviously, you can generally do two of those things, but doing all three is very, very difficult. And we work within quite a highly regulated framework as well, where it aligns to our values of keeping, making sure that members are basically safe for the money. That it's a sustainable business model. We don't lend too much to them. We don't lend it at an interest rate they're going to struggle to pay back. But to an extent, we are caught in the middle, but that's the nature of our job. And to make sure we can help as many people as we can and be really clear about how we can do that is probably the best we can do, and we strive for that every day.
But of course, all lenders are controlled by the same regulations, aren't they? But you are in a very competitive market because there's a lot of you trying to lend a lot of money. But you are all controlled by the same regulations as to how you do what you do and how much you can lend, etc., etc. Paul, I mean, any thoughts on that? Because there are lots of you, and you're controlled.
It is. That is where the customer should ultimately win. Is that we are all fighting in a marketplace, or competing in a marketplace, which is the products are relatively similar. We will nationwide will differentiate ourselves. We make sure we take care of our existing customers. We talk more about our social purpose and the reinvestment of those profits, and being member owned, and all the good things we do. But ultimately, we do compete in a very commoditized market where we will be held to the same account as very big banks as well.
And are you constantly, you must be constantly changing your products, weekly, depending on whether you're in the market, whether you want to lend to that person or not especially want to lend to that person, but things might change in the weeks, months ahead. You must be constantly moving things.
Yeah, I mean, as you've probably seen, the market, you're right, the market does generally reprice, much more often than the savings market, for example. Yeah, it's based on a lot of things, internal risk appetites.
Yeah.
It's based on general business flows. I mean, again, we want to maintain a really good service standard for customers who choose to borrow with us. If we have too much of that, and then it potentially is going to impact people who maybe on a tight moving deadline. So we need to be cognizant of that as well. So there's many things that go into it. And like I said, we are always trying to balance, spin many plates.
Yeah. You'll never please anyone. You'll never please everyone.
Please some people.
To say. I apologise, slip of the tongue. Just finally, if I may, because you've mentioned existing customers and how carefully Nationwide like to look after existing customers. Just a word on the remortgage market. How's that looking at the moment?
So the remortgage, with all the potential uncertainty around employment prospects into 2021, 2022, the uncertainty around what's going to happen after the stamp duty holiday finishes, remortgages are going to be more important in the market in 2021 is our view. For us, we do everything we can to make sure that our existing customers have access to really, really competitive deals when they come to their not only their deal end, but if they need to do something else, borrow money to fund upgrades to their property or move house and borrow more. We try and make sure that their ability to do that and the rates that they get when they do that are among the best in the market. So we will be trying to fight against that trend a little bit, but understand as well that that's probably going to be where a greater amount of growth in the market comes in 2021. So remortgaging will be a key battleground.
Yeah, I mean, it's a very important part of your business, isn't it? It would be.
Yeah. I mean, we are more geared towards house purchase. Very strong support of the first-time buyer market in particular, but in particular, we're going to have to face into that. I mean, that's our key strategic purpose. Is why we were set up as a building society to lend money to people to buy houses. But like I said, we can't be fighting against the tide of the market equally, and so we're going to need to be, and that'll probably see more competition in the remortgage market over the year.
Paul, thank you very much for your time. Really good to hear your thoughts on behalf of the Nationwide. Please carry on doing everything that you can to help those poor first-time buyers, people struggling to get onto the market. It seems like the odds are stacked against them, so anything that can be done should be done because it helps the whole market. But once again, thank you very much. Really interesting, thought-provoking, and very kind of you. Thank you.
Thank you, Phil.